Gold at $2,180 isn't a headline, it's a constraint, and the market just ran into it at full speed while a whole ecosystem of people pretended it was just another day. Because what changed in the last 24 hours wasn't a single magical news item, it was the balance of pressure inside the plumbing, who needed out, who was forced in, and which side suddenly had to pay up for liquidity. And once you see the mechanism, you stop arguing about narratives, and you start watching the signals that actually move first. Stay with me, because by the end, you'll have three things most people don't know how to the hidden detail that reframes this entire move, the calendar trigger that decides whether $480 becomes a floor or a trap, and the one level that, if it breaks, changes the math for next week. In the last day, the market didn't wake up and discover gold. Gold has been there. The story has been there. What changed is that the marginal buyer showed up at the same time the marginal seller disappeared. And price had to do the only thing it can do in that moment, jump. That's the piece retail investors miss, because they're trained to think markets are like voting booths. More fear equals higher gold. But markets are more like auctions in a hallway during a fire drill. The price is whatever clears the crowd with the least resistance. And over the last 24 hours, resistance thinned, liquidity thinned. The number $2,180 didn't become important because it's pretty. It became important because it sits where multiple forces collide. Round number psychology, clustered stop orders, dealer hedges, and the quiet reallocation decisions that institutions make when they feel the floor under their currency assumptions creak. And that's where the real pressure starts. So let's stop pretending this was mysterious. Here's what likely happened in the way markets actually work. First, you get an impulse. Maybe a shift in rate expectations, maybe a wobble in the dollar, maybe a geopolitical flare, maybe simply a risk-off ripple that hits equities and bleeds into haven demand. On its own, that impulse is ordinary. The second ingredient is what makes it explosive, positioning. If too many people are leaning the same way, short gold because yields are too high, or underweight gold because it's already up, or running systematic strategies that sell volatility and get complacent, then a small impulse turns into a scramble. And the scramble isn't about beliefs, it's about risk limits, margin, and hedges. Someone gets tapped on the shoulder by their risk manager. Someone's stop gets hit. A dealer's book flips from comfortably hedged to uncomfortably exposed, and suddenly the market is not debating whether gold should be higher. It's hunting for offers that aren't there. But that's not the part that matters. The part that matters is why it happened now. Because now has a calendar. Markets are not continuous, smooth machines. They're lumpy. They have windows where liquidity is thick and windows where it's thin. And if you've watched metals long enough, you know the big, rude moves tend to happen when the calendar forces people to touch their positions. Month end, quarter end, option expiry windows, futures roll periods, delivery windows, policy meetings, data weeks, and those awkward patches of thin liquidity where one aggressive order can punch a hole through a level that everyone assumed was solid. If you're looking at $2,400 right now, the first question isn't, what did the news say? It's who is forced to act this week, and what do they do if price moves through a strike cluster or a risk trigger? Because if this one level breaks, the math changes. Now, here's the hidden detail most people miss. When gold moves fast, the screen price is often the last thing to tell the truth. The first truth usually shows up in the relationships around gold. Rates, the dollar, volatility, and the way the derivatives market reacts. Think of it like this. Spot gold is the headline, but the spread and the hedge flow are the confession. When the move is real, you'll often see the incentive shift first. The opportunity cost of holding gold gets cheaper, or the currency translation makes gold more attractive globally, or the hedging flow creates a mechanical bid that feeds on itself. And once that bid is in motion, the narrative arrives late and takes credit. That's why you'll see people arguing about why after the fact, while the market already moved. But the next detail is what flips the whole setup. It is not just that gold is non-yielding. It's that gold competes against real yields and currency confidence, and those can change in a heartbeat when the market starts pricing a different policy path or a different risk regime. Let's make the rate piece painfully simple. If you hold cash or short duration treasuries, you're earning something. If you hold gold, you're not. So in a world where real yields are rising and the dollar is surging, gold has a headwind. But if the market starts to price lower future rates, or inflation expectations creep while nominal yields don't keep up, or the dollar loses its bid, that headwind eases. And when the headwind eases at the same time, positioning is offside, gold doesn't politely grind higher. It snaps. Because people who were short gold, because rates suddenly have to buy gold because risk. Same asset, different reason, same outcome. Forced demand at the worst possible time. And that forced demand is what you're feeling in the last 24 hours. But that's not the part that matters. The part that matters is what it forces participants to do next. When a market tests a level like $2,180 after a sharp move, it's not just price discovery, it's a negotiation between three camps. Camp one is the dip buyers, strategic allocators, longer-term hedgers, people who want exposure but hate chasing. Camp two is the momentum crowd, systems and traders that respond to breakouts, volatility expansion, and trend signals. Camp three is the trapped side. Anyone short, anyone underhedged, anyone who sold calls, anyone who sold volatility and now has to buy it back. If the level holds and consolidates, Camp 1 gets their entry, Camp 2 stays involved, and Camp 3 keeps sweating. If the level rejects hard, Camp 2 bails, Camp 1 waits, and Camp 3 breathes. That's the fork. And the market will try to shake you out right at the fork because that's where liquidity is. That's where stops cluster. That's where emotions peak. Now we have to talk about the paper market versus the physical market because this is where trust is either earned or lost. Gold price discovery happens mostly through futures, and the broader derivatives complex. That's not a conspiracy, it's a structure. The futures market is liquid, leveraged, and fast. It's where institutions express views, hedge exposures, and manage risk. Spot follows because spot is connected through arbitrage and dealer inventory management. But physical demand still matters because it sets the tolerance for how far paper pricing can stretch before someone says, fine, I'll take delivery. Or, fine, I'll source elsewhere. Or, fine, I'll pay a premium. And you don't need to claim shortages every time gold rallies. You just need to understand that physical flows are slow and sticky, and when the paper market jolts higher, the physical market responds with a lag, sometimes with higher premiums, sometimes with delayed supply, sometimes with rationed availability at the retail level. That lag can reinforce the move because it changes behavior. People stop waiting for pullbacks and start buying before it gets away. And that's where the psychology flips. Watch what happens in the street-level symptom layer after a sharp 24-hour move. The conversation changes from, I'll buy if it dips, to, I need to get some exposure. Dealers and platforms get a rush. Premium chatter starts. Delivery timelines start becoming part of the discussion. None of that is a perfect data series, but it's a real-time behavioral indicator. It tells you whether this is just paper leverage sloshing around or whether demand is broadening. And here's the trick. Broadening demand doesn't need to be massive to matter. It just needs to be steady while the supply of willing sellers dries up. That's the part that feels unfair. You keep waiting for the proper pullback, and instead, you get shallow dips and sudden pops. That's not magic. That's an auction with no offers. Now, let Yes get specific about the mechanism that can make a move like this accelerate. Options, reflexivity. You don't have to be an options wizard to understand this. You just need one picture in your mind. Imagine a dealer who has sold a bunch of call options to investors. If the price rises, those calls gain value. The dealers short that upside exposure. So to manage risk, they buy some underlying exposure, often futures, so they aren't destroyed by a runaway move. That hedge isn't static. It changes as price changes. Delta is how sensitive the option is to price. Gamma is how fast that sensitivity changes. When price is far from the strike, the hedge needs are smaller. When price approaches popular strikes, especially round, psychologically obvious ones, hedge needs can rise quickly. That means as price rises into that zone, the dealer may buy more to stay hedged. That buying can push price higher, which requires more hedging, which pushes price. You get the idea. It becomes mechanical. No one has to believe in the rally. They just have to manage risk, and that's where the market becomes a machine. So if $2,408 is the level on your screen, don't just stare at it like it's a horoscope. Ask, is this level near a region where options positioning is likely concentrated? Are we in a window where options are rolling, expiring, or being rebalanced? Are dealers likely long gamma, meaning they dampen volatility, or short gamma, meaning they amplify it? Because if the market is short gamma around a big zone, you get those sharp, breathless candles where dips get bought instantly and rallies feel like they're climbing a wall. But if the market is long gamma, you get mean reversion, chop, and those infuriating fake breakouts. This week, the calendar and positioning decide which one you're living in, and that's where the real pressure starts. Now let's talk proof, because you don't build trust with vibes. You build trust with a stack of mechanisms that all point the same direction, while admitting what could break them. Proof point one is the rate cut math, or more broadly, the rate path repricing. Gold doesn't need rates to collapse. It just needs the future path of rates to soften relative to what was priced yesterday. Markets move on changes at the margin. If yesterday the market expected a higher for longer parity with confidence, and today it is even slightly less confident, that shift alone can lift gold, especially if the dollar relaxes with it. Proof point two is the dollar itself. Gold is global. A strong dollar makes gold more expensive for non-dollar buyers, which can dampen demand. A weaker or wobbling dollar removes friction and can pull global demand forward. Proof point 3 is volatility. When volatility rises, it changes the cost of hedging and the behavior of risk parity and vol targeting strategies. Some of those strategies cut risk when volatility jumps, which can force selling in equities and other assets, pushing capital toward perceived havens. Proof point 4 is positioning an open interest behavior in futures and options. What happens when a level is tested and the market either absorbs it or rejects it. Proof point 5 is cross-market confirmation. Silver, miners, and even certain currency pairs can either validate the move or hint it's fragile. And proof point 6, quiet but powerful, is institutional flow behavior. Not because ETFs are the whole story, but because flow regimes matter. When flows are absent, rallies are fragile. When flows return, rallies gain persistence. Here's why institutional flow matters in plain English. If the move is driven mostly by short covering, you get a burst and then air pockets. Shorts cover, buying pressure fades, price stalls. But if the move starts pulling an allocation, money that isn't forced, money that is choosing, then pullbacks get bought because the buyer isn't done. Allocation money scales in. It buys weakness. It doesn't panic, sell the first red candle. And when allocation money overlaps with constrained liquidity and options reflexivity, you can get those uncomfortable upside skew moves where every dip feels like a trap for the bears. But that's not the part that matters. The part that matters is how you avoid becoming the liquidity for someone else. Because the market will now try to manipulate your emotions in the simplest way possible. By making you feel late, then making you feel stupid, then making you feel panicked, then making you chase again. First, it rips, and you feel left behind. Then it dips just enough to make you think, here we go, and it wicks lower to hit stops. And then it snaps back up, and you feel betrayed. Then it runs again, and you chase. That cycle is not an accident. It's how liquidity is manufactured in a world where everyone watches the same levels and uses the same risk triggers. So your psychology shield is this: separate trend signals from noise. A trend signal is structure, higher highs, higher lows, constructive consolidation, and price holding key zones on a closing basis. Noise is intraday wick drama, headline whiplash, and thin liquidity spikes that reverse in minutes. You can respect noise without obeying it. You can acknowledge volatility without letting it dictate your decisions. Because if you let volatility set your timing, you become the product. Now, we need the physical versus paper nuance without getting lost. Well, one of the most misunderstood topics in metals is inventory. People throw the word around like it's one bucket. It's not. There are categories that matter because they change deliverability and behavior. There's metal that exists but isn't available for delivery against futures, metal that is eligible but not registered, metal that is registered and deliverable, and metal that's functionally locked due to ownership intent. The reason this matters is not because you're trying to predict apocalypse. The reason it matters is because during stress, the market starts caring about deliverability, and that can affect spreads, delivery demand, and the willingness of participants to roll positions. If deliverable supply feels tight relative to demand for delivery, spreads can behave differently. If the incentive to take delivery rises, paper pricing gets challenged. And if the incentive falls, the market stays comfortably financialized. You don't need exact numbers to understand the logic. You just need to know what to watch. Signs of stress usually appear first in the structure, spreads, roll behavior, and the urgency of nearby contracts relative to deferred ones. That brings us to term structure, the quiet signal that's often more honest than the spot price. When nearby pricing is rich relative to later pricing, it can indicate urgency for near-term supply, or at least urgency for near-term exposure. When later pricing is richer, it can indicate comfortable carry and less immediate stress. Gold often trades with carry influences, so you don't treat every shape as shortage, but you do treat changes in shape as information. If the curve starts to behave in a way that suggests near-term demand is pulling forward, that's a signal. If spreads start screaming while spot looks calm, that's a signal. And if spot is screaming while spreads are yawning, that can be a caution flag. Sometimes the move is more about financial leverage than physical urgency. But that's not the part that matters. The part that matters is the global arbitrage. Gold isn't one market, it's a chain. Price in one place pulls price in another through arbitrage. Buy here, sell there, hedge the currency, ship or swap, capture the spread. That mechanism is what keeps global gold pricing coherent most of the time. But when friction rises, FX stress, shipping constraints, policy changes, sudden demand spikes, those arbitrage links can tighten or strain, and local premiums can appear. Even if you never touch a bar of gold, these frictions matter because they affect the incentive landscape. They can change how fast supply responds, how quickly demand is satisfied, and how violent price discovery becomes on the screen. If the world is pulling on the same bar at once, the weakest link decides the price. And if that link tightens in a week, where liquidity is thin and options positioning is sensitive, the move can look like mania, even when it's just mechanics. Okay, so with all that in mind, let's get brutally practical about what comes next, because this is where the video earns its keep. From here, there are two clean paths, and you'll know which one you're in faster than you think. Scenario 1 is the controlled pullback and retest. Price spikes into 2,180, maybe pokes above, then cools off. It pulls back toward a prior breakout zone, maybe a shelf where buyers previously stepped in. It chops, it frustrates. Headlines fade, everyone gets bored. Then it holds that shelf. Importantly, it holds on closes, not just on intraday wicks, and it starts to coil again. That is the market saying, we found a new balance higher. That scenario is healthy because it builds a base. It shakes out weak hands without breaking structure. It gives dip buyers a chance. It keeps momentum traders interested. And it keeps the trapped side uneasy. But that's not the part that matters. The part that matters is Scenario 2. Scenario 2 is the continuation squeeze with gap risk. In that world, dips are shallow and violent. Every attempt to push it down gets absorbed quickly. The market starts closing near the highs of the day more often than not. Breakouts don't retrace much. And you'll feel it in the tape, the way price moves through offers like they not there. That's often what short gamma conditions look like, especially if positioning is offside. It's also what happens when the dollar drops at the same time yields refuse to rise, because the opportunity cost argument collapses, and gold becomes the cleanest expression of, I want out of fiat risk. In that scenario, the risk isn't on just upside continuation. It asks that the market can gap through levels in thin liquidity windows, leaving late sellers and hesitant buyers staring at a price they never got to transact. That's why risk management matters even when you're right, because being right is not the same as being positioned to survive the path. So what levels matter? You don't need a dozen, you need a map. $2,480 is your pivot because it's the level the market is currently negotiating. Above it, the market is trying to normalize higher pricing. Below it, the market is asking whether the move was a spike. The next obvious magnet above is the big psychological zone everyone sees, often a round level where options strikes cluster and where people place take profit orders because it feels like a target. The next important shelf below is the area where the breakout started, where price accelerated and left footprints. That shelf is where you want to see buyers defend if the move is real. And the line in the sand, the invalidation level, is not any red candle. It's a clean break back below the base that started the move, especially if it happens alongside rising real yields and a rebounding dollar. Because if that happens, it means the macro tailwind reversed and the structure failed. The math changes. Now, let's translate that into what to watch next week without turning this into a graduate seminar. Watch the dollar. Not because the dollar is destiny, but because gold often moves hardest when the dollar's trend changes. Watch real yields, or at least the rate narrative, because gold hates a world where real returns rise and loves a world where they soften. Watch volatility, because volatility changes behavior, especially for systematic strategies. Watch how gold behaves around the pivot. Does it wick below and snap back, or does it break and stay broken? Does it close strong, or does it fade? Watch the quality of pullbacks. Healthy markets pull back in a controlled way, with declining urgency. Fragile markets pull back like a trapdoor. Watch the correlations. If miners confirm and the silver holds, it can validate broad, precious, complex strength. If they diverge, it can hint at a narrow, financialized move. And watch the derivatives behavior. If you see repeated sharp rallies into the same zone and dips that refuse to deepen, that's often hedging flow at work. But that's not the part that matters. The part that matters is how you act on it without becoming exit liquidity. Here is the disciplined framework that keeps you sane. Remind yourself that price can whip around violently even if the thesis is correct. A correct thesis can still include a brutal pullback. A correct thesis can still include a fake breakout. Your job is not to predict every candle. Your job is to identify whether the environment is trend-friendly or chop-friendly, and whether the signals that matter are confirming or diverging. If you're a shorter-term trader, you respect levels and volatility, and you size so you can survive noise. If you're a longer-term investor, you respect structure, and you avoid letting intraday drama bully your allocation. And you keep a two-scenario lens in your head at all times. Controlled retest scenario. You want to see higher lows and buyers defending shelves. Squeeze scenario. You want to see persistent strength and minimal giveback, but you also respect gap risk, and don't confuse speed with safety. Now, let's address the skepticism directly, because this audience doesn't want fairy tales. Could this move be fake strength? Absolutely. It can be driven by short covering. It can be driven by a one-off headline that fades. It can be driven by thin liquidity that exaggerates price. It can be driven by options-related flows that unwind after the window passes. It can even be driven by a broader risk-off wave that reverses if equities stabilize and yields rise. That's why you don't marry the move. You date it with boundaries. If the move is real, it tends to leave footprints. It holds key zones, it absorbs selling, it keeps reclaiming pivots quickly after dips, and the macro inputs don't flip against it. If the move is fragile, it tends to do the opposite. It spikes, it fades, it fails to reclaim the pivot, and it starts reacting negatively to the same macro inputs that previously helped it. The market will tell you. You just have to listen to the right part of the market. So let's tie it back to the hidden detail one more time, because this is the core takeaway.